All right, so we saved the best for last. Panel 3 is on best execution. So John and I are joined by David Demetrius, Senior Special Counsel in the division. We'll kick off as we have for the first 2 panels by each panelist. Go down the line, introduce yourself, your name, your affiliation, and a couple sentences about what you do. So, Mr. Brooks.
Thank you, Jamie. Chair Atkins, Commissioners, staff for hosting this roundtable and facilitating an important discussion, which hopefully will result in better markets going forward. Jamie, I know you guided us to a quick intro and a couple sentences, but given the prompts from Chair Atkins and Commissioners earlier leading towards Best X, I do want to share a quick introductory comment. I'm head of trading at the London company, Richmond, Virginia-based asset manager. I've traded exclusively on the buy side for more than 30 years, both pre and post the implementation of Reg NMS. I agree with many of the panelists on these roundtables who have commented on how markets have evolved significantly since the implementation of Reg NMS. And that, to torture Jim Angel's analogy again, the necessary scaffolding that Rule 611 represented to manage the massive changes associated with Reg NMS is no longer necessary as markets have become fully connected. Broker, market venue, and buy-side trading technology have evolved and become more robust. Equity execution has become more electronic, and data accessibility and integrity have improved dramatically. And with respect to Best X, the tools available to the buy side, in particular cost models that estimate the prospective cost of execution for a given order, and software standard benchmarks and peer data for the post-trade evaluation of execution quality are more readily accessible, easy to understand, and cheaper. It's now more straightforward to assess an execution outcome as good or bad than ever relative to the priorities and expectations of a given investor. That said, it's not free and one size does not fit all. The London company is a mid-sized investment manager with $33 billion in assets, and our clients run the gamut from small retail investors and wrap programs to large institutional investors and multi-billion-dollar mutual funds. We're able to spend on vendor transaction cost analysis tools that help us assess execution outcomes against standard benchmarks and those that are relevant to each of our clients. When Med speaks of T. Rowe's ability to achieve good outcomes on his clients' trades through a principles-based Best X approach, I envy the resources that his team can bring to bear internally to evaluate execution quality down to very granular process perspectives. Assessing execution quality in a manner that can point to process changes that can lead to improved outcomes is a heavy lift. For many smaller advisors who either don't have discretion on broker selection or don't have the resources to do this work internally or the budget to work with outside vendors, they need to be able to access standard reports from brokers and market venues that help convey good and bad execution in a clear manner.
My name is Calvin Hayes. I'm responsible for U.S. equities trading at Jane Street. That includes our on-exchange market making, single dealer platform, retail wholesaling platform. Jane Street's a global quantitative trading firm. We trade a broad range of asset classes on more than 200 venues in 45 countries. And we're very thankful for the commission inviting us here to talk about these important topics. If you're going to make a change to an important, core market set of rules, it's great to have the industry together to talk about what the potential unintended consequences are.
Good afternoon. My name is Anna Kurzrock, and I'm a managing director and head of market structure at Jefferies. Jefferies is a subsidiary of Jefferies Financial Group, an independent global full-service investment bank focused on servicing our clients for over 60 years. We are a U.S.-registered broker-dealer and equity trading firm dedicated to providing the highest quality execution to our institutional clients. We are a strong advocate for markets that are fair, transparent, and efficient. And as such, pertaining to today's discussion, no single rule, we believe, can be held responsible for creating or eliminating the efficiencies of a market, particularly those in the U.S. We look forward to today's discussion and believe that it will be insightful and thought-provoking, and that we will be able to come to some solution to make things better. We thank the Commission, Jamie, and the Division of Trading and Markets, and look forward to today's discussion.
Hi there. I'm Chris Nagy. I'm with the Healthy Markets Association, and I'm thrilled to be here in Austin today. And I'd like to thank the chair, Jamie, and the whole TNM team, Commissioner Peirce, Commissioner Ueda, Commissioner Crenshaw, who was on the phone. It's a really exciting time. I submitted a comment letter. It's not my first on Rule 611. In fact, before I was old enough to sign comment letters, I'm included in the chair's dissent on Reg NMS. I've since submitted a lot. You can read about my latest comments, file number 4-862, and the comment submission link with the SEC. I submitted that on Friday. But I'm really excited to be on this panel because this panel is the first panel to talk about what Rule 611 is, which is a best execution rule. It's really the only best execution rule that the SEC really has. So I'm thrilled to be part of the discussion today, and thank you.
Good afternoon. I'm Raquel Russell, the head of Capital Markets Policy at FINRA. FINRA is a national securities association and does not operate a market. FINRA has Rule 5310, which is our best execution rule. We believe it's been a very effective tool in investor protection over the years. Thank you very much for having me here today. I look forward to engaging with my fellow panelists about how BestEx can continue to be an effective tool in the event of significant market structure changes on the Reg NMS level.
Hi, I'm Jamie Scriber. I work at Goldman Sachs, where I oversee our U.S. cash equity businesses. Thank you very much, Jamie. To use your terminology, I greatly appreciate the opportunity to discuss the evergreen obligation that is best execution. It is core to any market structure discussion, and I look forward to a robust debate with my fellow panelists.
Great, thank you. Thank you all for joining us. My name is David Demetrius. I work in the division's Office of Market Supervision. And yes, so the goal of this panel is to talk about the implications on best execution for changes to or rescission of Rule 611. Today we heard about a bunch of other rules that are implicated if Rule 611 were to be rescinded or modified. This included things like access fee caps, the 605 reports, the impact on the MBBO, customer disclosures, and these are all topics that we intend to cover today. And our panel consists of participants and experts on both the institutional and retail markets. And the challenge and the goal of today will be to discuss implications for best execution in the context of each market, because each market's order handling can vary. And so we want to kind of try and hone in on implications for best execution in the retail market separately from implications for best execution in the institutional market. And so I think we'll focus on a couple of assumptions to begin with. First, if we were to rescind 611, and secondly, let's talk about the retail market first. And I think Commissioners Peirce and Ueda had a great suggestion for how to begin this panel, which is a very basic question. Do you think there needs to be BestEx guidance concerning retail order handling if Rule 611 were to be rescinded? And if so, what do you think that guidance should be, and should it be provided by FINRA or the Commission? And as a layer on that, does the guidance need to be principles-based or more prescriptive? Jamie, Calvin, Chris, I know y'all have perspectives and participate in the retail market, so maybe we can begin with you all. And Jamie, maybe we'll start with you.
Sure. I mean, stepping back, I think it's fair to say we support a full repeal of 611. We think, as Chair Atkins highlighted, and as we had highlighted 20 years ago, the implementation would potentially create market fragmentation, and that has come to pass. We've seen a great deal of proliferation of venues and market centers. So we think that at this point it's doing more harm than good. We think it's important to pair that with a principles-based approach. to best ex like we currently have with FINRA's rule. We think that it's a key differentiator of execution services to allow brokers really to deploy their full set of capabilities, expertise, and strategies to deliver best ex to clients, and that any more prescriptive ruling or guidance may actually harm investor choice. As it pertains to retail, as I think we kind of heard in one of the other panels, I mean, for the most part, retail execution is very close to midpoint. And so I think that, to the extent we need to update price benchmarks, and we should absolutely have fair and transparent and easy to understand price benchmarks. That's a relevant discussion, but I would not think that there would be additional guidance or disclosures warranted for retail execution specifically.
I'd be happy to jump in. So I disagree with that a little bit from the standpoint of FINRA Rule 611 is essentially an order-by-order best ex rule. Every time it goes into the marketplace, there's some assurance that you're going to get the NBBO in the marketplace. If you rescind that, if you want to take it away, great, but then you need to throw that responsibility back onto the broker-dealer. Now, FINRA, the rules around best ex, they're really dated. I mean, if you go back and read like 01-22, so that was released in 2001, 22nd notice to members, it's kind of the same as Rule 5310, except the difference is there were some caveats added in there. One, ironically, was FINRA said, hey, technology exists to be able to do order-by-order analysis today. Well, yeah, it does. Actually, we see it all over the news today. AI is sweeping everything. The possibility to do that and put that in the broker's hands is there. So I would suggest, and my recommendation to the commission would be that on a retail perspective, I'm not talking institutional. If I get asked that question, I'll chime in. But on a retail perspective, price is kind of the elevating factor there. And it should be on an order-by-order basis. But even going further than that, when I do a trade through my retail channels, I get my price improvement on the trade confirmation. Well, if I'm going to get disimproved on a trade, why can't I get that on a confirmation? It's pretty simple to do, right? Like, not very hard. I think there will be questions about the NBBO that when we were talking about the vendor display rule on the earlier panel, that would be very, very important in that caveat. So that's kind of my 2 cents worth right out of the gate on that topic.
Yeah, I guess from our perspective, we're generally supportive of considering changes to or the rescission of 611. We think modern markets have evolved to electronic trading, fragmented markets, et cetera, but very interconnected to the point where the rule is mostly superfluous. But I agree with the notion of 611 as kind of an extremely weak order-by-order best execution obligation, in addition to its role in connecting the markets to the national market system. And so what further guidance is needed if you rescind 611? I mean, I think a little of it depends on what you're going to do with 610. The first panel had an excellent discussion on locked in cross markets and on access fees, and the most maximalist set of repeal, I think, could lead to a situation where the prevailing, trying to decide what the prevailing NBPO is, frequently crossed, et cetera, you have some horror stories possibly. And it makes it, it would make it very tough, and we would need guidance on how to deal with this situation and provide execution quality back to retail investors that they can understand and respect as being best execution. I mean, I think we generally think of 611, referenced earlier, 611 and best execution as pretty separate obligations. In some sense, compliance with 611 is kind of neither necessary nor sufficient to be delivering best execution. You say, well, I've complied with 611, and the very reasonable responses, but then there's lots of midpoint and other hidden liquidity out there. Did you find that? There are odd lots out there. Did you find that? And so the standard is in some ways a lot higher. You could imagine for institutional block order, you could provide best execution without the going through the sweeping of the layer of the top order book or whatever. So in some sense we think of it as different things. And I guess also even just beyond potential changes to 611, I think the reference that it's possible we could, do better on guidance in 5310 for market participants. Aside from potential changes to 611 is a thing worth thinking about. We talk about prescriptive or principles-based. I think the existing rule and what we would hope would be more principles-based. Let the professionals use their knowledge and context of the marketplace and knowledge of their customers' needs to come up with a means of displaying that they're providing the fiduciary duty that they owe their clients. But the one thing that I think we would mostly encourage a shift in the direction of is outcomes-based analysis of best execution as opposed to process-based. So can you demonstrate that the outcomes that you're delivering are what your clients are looking for? And so that's the biggest change I think we would support.
Thank you. Raquel, FINRA's Rule 5310 and its predecessor from the NASD have been around for a long time, as Jamie was noting earlier in his remarks. And the rule obviously has a lot of considerations that broker-dealers should be thinking about when they're executing customer orders. You obviously, your organization provides regulations for broker-dealers. Y'all interact with broker-dealers on a regular basis. Based on your feedback from your membership, what are FINRA's thoughts or your thoughts about the current FINRA rule and any kind of updates, clarifications, considerations in a world where we didn't have Rule 611?
Thank you. I think that additional guidance will be necessary. Without a 611, you have less of a regulatory obligation that tells broker-dealers where it's less prescriptive in terms of exactly where you need to send your customer orders. The earlier panels raised a lot of really important factors. Right now we have, quite a few equity exchanges, for example, and we talk about no longer needing an ISO. So then you have a broker-dealer that's looking to see where to send their orders. We think it's important that, given the Commission's role in establishing and enforcing best X standards, we think it's important that additional guidance be worked on collaboratively, and we look forward to doing that. We also think that additional guidance should really be looked at carefully in collaboration with getting additional information from members, because there are many different models. And one of the encouraging things that we've heard from many people, especially over the past few years, is that the principles-based approach to the rule has been helpful and it's been working in dealing with quickly evolving marketplaces. And when we look at what the factors are and whether or not we would want to, in addition to guidance, possibly look at additional factors, you look at things like what is part of the rule text right now for members in using reasonable diligence. It's things like the accessibility of the quote. We've talked about that at length today. That could be it would be different depending on whether they're 610 or what changes with access fee caps, whether they're there or not. But that principle can continue to be relevant, in many different future market structures, but we can dig into what guidance might look like in our current time if we got rid of 611. Another factor that currently exists is the number of markets checked. That principle will continue to be relevant. So that's just to say that a lot of the principles that are in the rule text now continue to be absolutely relevant and can be dug into. In the case that we looked at, changes 610, 611, and I think it would be important to work carefully with members, maybe using some illustrative examples and digging into what makes sense and what effective practices might look like in some key scenarios, because the goal is investor protection and members are the ones that customers place their trust in when they send the orders. And members are the ones with the expertise, the data, and the ability to use their reasonable diligence at the time of making these decisions. So in all, I think additional guidance would be important. I think that the principles-based general framework is effective. That doesn't mean that any additional rule text it's precluded, but the principles-based approach is working. And we absolutely should dig in to make sure that any additional guidance is carefully crafted in consideration of the different business models and priorities that our members have. And David, you asked about feedback that we're hearing from members. Right now, members, always raise, there are always so many new scenarios, and members raise different questions around what could be effective under different circumstances. And then especially as people think about what a future might look like, we do think that members are interested in order by order, when it's required and what it looks like. And we are also aware that members talk a lot about the execution of small orders. If we're talking about retail right now, small orders and considerations around that. And of course, we know that new changes are coming in terms of creating a consolidated quote for odd lots. So those are some of the issues that we hear from our members and that we're happy to dig into.
Thank you. So maybe we can pivot to the institutional market. Same question. We're assuming that Rule 611 is rescinded. Would Best Ex guidance be helpful concerning institutional order handling? And if so, what guidance should be provided? Obviously, as we were saying, there are lots of factors in the FINRA rule, but is there something about rescission of 611 that would merit additional guidance regarding best execution and order handling for institutional orders? Anna, Jamie, maybe Jamie putting your kind of institutional cowboy hat on, and David, if y'all could speak to this, and maybe Anna, we could start with you.
Sure. I do think in short that there will be additional guidance necessary to supplement FINRA's best execution rule. However, I think some of that will need to be determined and will be driven by what the definitions will become, whether it's what the MBBO looks like, what protection looks like, not protected. But going on the assumption that it is rescinded, I think the key to remember from an institutional standpoint is that brokers handle orders differently than other brokers. So, for example, if you have an institution that sends the same exact order, same price at the same exact time to two different brokers, 99.99% of the time, both of those brokers will execute that order in different manners and also access different venues to achieve those same goals, even if the client has the same instructions. Some brokers decide to use certain ATSs over others. So I think the key to any kind of guidance is, while it is going to be necessary in light of what comes down the road, I think something too prescriptive is going to be, I would say it would be discouraged. Simply because if, we recall, as, obviously in preparation, all of us were preparing, but I actually went back and I read a lot of the comment letters and the best execution rule that was proposed by the commission in December of 2022. And that was probably the underlying common theme that most of us were in agreement with. So that if it becomes too prescriptive, it doesn't allow the broker to exercise their expertise and thoughtful decision making in achieving the goals that are best for their clients.
Yeah, I would agree with Anna and echo her sentiments around the importance of broker flexibility. I mean, that's something we highlighted in our comment letters in 23 and 24. I also think it's important to acknowledge, in addition to the diversity of broker strategies for execution, there's a tremendous diversity of how clients, and David hit on this a little bit around the tools and techniques and incredible sophistication that the buy side now has to evaluate broker execution quality, but just how we are utilized by clients, right? So you may have a client that is evaluating our performance on smart order fills and a very short time scale, and at the same time you may have another equally sophisticated, extremely large client that is evaluating our performance at a grandparent order level on a portfolio rebalancing that might have taken place over several days. And so to try to come up with guidance that solves for all of these different use cases, I think will be extremely challenging. I like Raquel's points around, kind of scenario or case study type approach. I do think FINRA's rule has evolved, as she highlighted, right, and stood the test of time over several decades. And I think that kind of, view where you have some core principles will continue to serve the U.S. market well.
I agree with both Anna and Jamie that overly prescriptive guidance is definitely not needed and could be very problematic. And I would point to the uptake of 606 broker routing reports by the buy side in general as evidence of that. I polled a few brokers, including one who commercially offers a service that aggregates 606 reports across their brokers and visualizes the results to see how many of their clients are currently asking for these reports. And in every case, it can be counted on less than one hand. So, and those reports, to Calvin's earlier point about best X should be more outcome based and less process based. The 606 reports were very well intentioned, but they have a lens that is very specifically focused on process. They're not helpful in determining whether outcomes are good or bad. And so I think while maybe some additional principles-based guidance could be helpful, overly prescriptive guidance could be really troublesome in actually continuing to evolve to more of an outcome-based model than a process-based model.
David, would you mind if I jumped in here real quick? I just have one point that I'd like to make on it. We kind of talked about retail and institutional, and there's kind of this gray area. Like we've heard of the top of institutional on the first panel today, and we've got a very large institutional person here in Dave Brooks. But there are a lot of advisors out there, and that's the vast majority of AUM. And a lot of these advisors actually channel through retail brokers. And so I think that presents a little bit of not only a dilemma, but something that needs to be thought about is how do you address that advisor that's going through the retail channel in achieving best execution. And I think there needs to be a little bit of a delineation there and perhaps some guidance with respect to broker-dealer custody.
I was going to mention also one thing that Jamie was talking about earlier that I think we deeply agree with, and it's not just relevant on the institutional side, is, as written, 5310 is contemplates, the best available market for a given order. And, we reinterpret this to mean the best outcome for that order, because in some case, the outcome in, a single child order isn't the end result for you talk about a portfolio rebalance or something, a large parent order intended for execution via institutional algo is, it needs a different set of metrics, a different set of understanding. And so, I think the idea that further guidance would be aware of the fact that different order handling has different client needs, I think would be super helpful and, maybe a reasonable update.
Thank you. Raquel, kind of the same thing, but on the institutional side. Anything different from what you said earlier with respect to the FINRA rule, the existing guidance in a world where there isn't 611 with respect to institutional order handling?
Sure. Our best X rule does not explicitly differentiate between retail and institutions, but of course those orders look very different and the customers are very different. So you have issues around size and levels of sophistication, even within the range of, what are considered institutional investors and customer expectations. And when we think about what I hear the most from members around their concerns with institutional best execution, it often has to do with the expectations of the customers and the priorities of the customer and the different concerns that institutions would have that go beyond price in a way that causes firms some consternation when thinking about what the expectations are. And so there are information leakage concerns, there are issues around having to execute very large sizes. And so I think guidance in that area from the institutional perspective would be something that seems to be helpful in helping members with their compliance processes. And of course, right now there is guidance that exists about checking venues and needing to check available venues. And in the absence of 611, that would likely be an area that would warrant additional discussion. It's not uniquely relevant for institutions, but that would be another area. But I think that the institutional space does include some additional factors that have to do with customer expectations that may not be as relevant in the retail space, and that firms would be looking or interested in getting additional guidance and scenarios on.
I'm sorry, can I make one more point? So we're talking a lot about guidance. Guidance is great, but if there's no enforcement associated with it, then what's the point of the guidance? So I think it's really important that when you're crafting this new regime, that you think about how is FINRA, how is the commission going to enforce these rules, right? So I think that's a very important point.
Thank you. Well, maybe we could pivot to something that came up quite a bit on the earlier panels, which was access fee caps. This isn't an easy topic. I'll just begin with that. But there was discussion about potentially, if you were to repeal 611, what would you want to do with access fee caps? Obviously, those came in when Reg NMS was adopted. And let's assume that we also undid the access fee caps and we no longer have a market structure where there are access fee caps applicable to exchange and protected quotes. How do we think about best X then? Do we need additional guidance? And if so, what guidance do we need if there weren't access fee caps applicable to displayed quotes? I think this is an issue for both retail and for institutional potentially. And so maybe we can just go down the line and get your views on that.
Access fees are important in that they're part of the overall cost of trading. They are currently, and they would be, presuming the elimination of access fee caps. We've done a lot of work at a process level, particularly at my previous firm, in trying to look at conflicts of interest with respect to broker routing and determining whether or not succumbing to those conflicts actually resulted in bad outcomes. We were never able to determine conclusively whether or not that was the case. Now that for us and other mid to large size investment advisors, execution quality analysis has evolved into something more outcome driven and less process driven. I don't want to say I'm less interested in the effects of routing decisions that are informed by access fees, but the outcome that we can see at the parent order level susses that out. And if we have brokers that are consistently making routing decisions that are primarily determined by or informed by access fee considerations, I would expect them to perform, relatively speaking, worse in our broker rankings in terms of execution outcomes than those who are not not trading off of those, not routing off of those conflicts as much. So from an institutional perspective, I don't necessarily think additional guidance, particularly on the prescriptive side, would be necessary to improve the process.
Yeah, before I jump into access fees, I want to underscore a thing that Mr. Brooks here just said, which I think is super important, which is the biggest driver for both institutional and retail execution quality is competitive forces among broker-dealers, like who is actually providing them the service they want. When we talk about our policies and procedures around best execution, like mostly we're thinking about the kind of bespoke corner cases where, for whatever reason, the commercial standards alone aren't doing the job. And so this is rare compared to this common case of if you're providing your client with an execution that they deem high quality, then they'll come back to you. And that's the thing that's most important. Yeah, on access fees, I guess even before any changes to 611, 610 or an access fee cap, like it's kind of already the case that the fee rebate environment for accessing publicly available quotes, it leads to open questions for us about what our best execution obligations are. 5310, one of the factors under consideration is transaction costs. But unfortunately for us in our industry, the standard is not to pass transaction cost all the way back to the end client. In some sense, the intermediaries take them one way or the other. And, this leads to an unnecessary conflict of interest in some sense. And so, we try and do our best. We try and consider, we consider the guidance to mean we can, in some sense, like, do you need to pay a cost of $100 to save your client $1 or something? Is that a reasonable thing to be expected to do? But if we could pay $1 to save our client $100, we definitely do that. And so I guess that's one phase in which we think some more guidance would be helpful. And yeah, eliminating the access fee caps. Yeah, I think, our friends on the exchanges this morning, made very reasonable arguments about, we could have net pricing. We could, describe on the quote what it's going to cost to access. But it's still kind of the case that this conflict of interest for any agent of an order that's going to absorb transaction costs is accentuated if you've got situations where you've got a, 2 cent a share, this obviously maybe won't come to pass, but 2 cent a share access fee and rebate. And now you've got markets that are crossed by a cent all day long. Yeah, how do you manage that? So it's a little bit tricky for us, I guess.
So I think, and by the way, the first thing I want to say is the 2 panels before us that spoke about access fees and, this issue, they really did a great job, certainly gave me a lot more to think about. But I think the real challenge when it comes to access fees is how we're looking to solve the problem. I think what we can't do is, look, I'd love to say that, and we are in favor of rescinding 611. At the same time, I also am in favor of, I'd love to say, get rid of the access fee, like competitive forces sort of play out. But we put them in there, unfortunately. And unfortunately today we can say, and they need to be addressed. I think the key here is that every stock's trading profile is different from another. And just recently, for the first time, with the round lot and the odd lot changes, the new regime, for the first time, we've actually inserted price into the Reg NMS structure, which has never been done before. The entire Reg NMS structure is designed intentionally to ignore stock price, which is unlike other markets, right? So I think that's where the challenge is, because whether or not a broker dealer would go, or everyone's going to take into account the cost of trading. That's certainly a fundamental part of 5310, and it's part of every broker's overall view of how they view the market and execution. But that access fee is going to be different for a $1,200 stock that trades with a 10-share round lot versus a $30 stock that trades with under a penny tick size. So that's where I don't think a solution or however guidance must be taken into account. I think it will be driven by what that definition looks like, and how we incorporate it. How do we change the access fee definition? And then because of that, how will brokers ultimately look at the market when they're trading stocks that are much more expensive versus others? And the ones with smaller round lot size that have less liquidity at the touch will also be a big factor in terms of which markets they access and how they incorporate the access fee and transaction costs for their clients.
So I'll just say I get it. The commission doesn't want to be in the rate setting game. And I can understand it from that standpoint. But access fee caps and Rule 610E, the cross locked rule, it's really not about rate setting. It's about setting a threshold in the marketplace. And I'll tell you, in my previous life, and it was funny, I heard, well, locked markets are ideal markets. That's exactly what you want. Well, I remember that day, and none of my market makers would execute my orders in a locked or cross market, locked markets and cross markets. So you have to, think back. Okay, so if we're going to take this rule out, right, and all of a sudden we're going to have an exchange that's charging an access fee of $1. That occurs in the options marketplace today, but that's a quoted market, not a traded market like our equities markets. And you heard it right here from Kelvin. If we're going to spend $1 to save 100, we'll take that execution. But if we're going to spend 100 and to give 100 back, and it's going to cost us 100, we're not going to do that. And that's a very real scenario, and that will happen. Markets will gravitate towards the lowest possible level. So I'll say, having the discussion about 610 is great, but or 611 rather is a good discussion to have, and I think there's a lot of a path forward. But if you're looking at repealing access fee caps and repealing the locked crossed rule, I think you're walking down a very slippery slope of unintended consequences that we don't know what the outcome will be.
I would just say that the best X guidance would definitely need to be different if there were no access fee caps, simply because that amplifies that element for consideration as members are looking to make decisions.
Yeah, I would agree very much with David's point around, aggregate execution quality really mitigating part of the broker-dealer conflict of interest there. But I would welcome from FINRA some additional guidance if we move to a net trading or net price type construct. I guess stepping back, though, wherever we end up with access fees, hopefully we can get to a place where we are once again, encouraging innovation and discouraging market center proliferation.
May I add one more thing, if you don't mind? Sorry, on the topic of access fees. One of the items in our comment letter for the Reg NMS tick sizes was that the commission does have authority to provide exemptive relief in conjunction, in the context of 612. And so I think because now, or initially when the access fees came about, stock price and, was not, and tick size was not necessarily the, were underlying factors in determining the access fee. Now it is, right? So I think because we don't have data in terms of, what the appropriate access fee is and what stock it should or should not apply to, that could be something that may be considered, at least in the interim, is the exemptive authority, which, I must say was originally provided by another exchange prior to the proposals that came out in December of 22, saying, okay, here we can provide, tick size exemptive relief so that you can quote and trade in smaller increments, provided that it's on condition of an access fee change, which were two things that I think many were in favor of, but that could be a way at least to, look or think about how, what that approach is, even though right now we know the access fees are, were approved and went through court at 10 mils across the board, but something along the lines, since, no change can be completely, a one size fits all. The change isn't going to necessarily apply to retail, to, the, RIAs and, and institutions. It's just something else to think about.
Thank you. Well, we could probably spend quite a bit more time on access fee caps, but maybe we can move on to another issue that came up before, Rule 605 reports. One of the main intentions of these reports is to help folks compare execution quality across broker dealers, understanding that there are other reasons why execution quality may differ across broker dealers. 605 reports were required before the introduction of access fee caps and Reg NMS. They were based on, I believe, the consolidated best bid and offers reflected the SIPs at the time. Jamie, Calvin, Chris, maybe we can focus this question to you all. Is eliminating the access fee caps, does that hinder the utility of 605 reports? Does the approach to 605 reports prior to NMS and Rule 611, would that be suitable? I can start with anyone.
I can start. Yeah, I guess the utility of 605 reports, I think we need to remember who they're currently being used for and for what purposes and what their utility actually is. I mean, I think maybe this is a contentious view that I have, but while I think that 605 reports are very useful for driving public confidence in especially retail investor outcomes, and I think they're useful as a policymaking tool, useful for the public. I don't really think they make for a useful way to disambiguate among market centers or broker dealers. Most of the outcomes-based 605 reporting, is driven by what selection of inbound order flow the venue is winning and under what environment. And so, yeah, I mean, I think 605s are useful and they're not that expensive to produce for us. And most of my concerns around, the new 605 rules around notional values, et cetera, that seem like, net improvements. So no objections there. But yeah, I think it's kind of the same theme on, we're going to need to, elimination of 611 means we're going to need to come up with an industry-wide definition of the NBBO that works. And once you have that, you can have 605s. And yeah, hopefully that industry definition of NBBO isn't like crossed all the time, but that's mostly about access fee caps. And yeah, we can go from there. I mean, I think that we can make it work probably. So.
I will say that I agree with Calvin. It's funny. For about 15 years, I beat my chest very hard on reforming 605. Talked to a lot of former trading and market staff who's here and about it, and it was revised and it's out. I think I was footnoted like 80 times or something in it. It's great. It's a great tool to check order flow on a post basis for destinations, as Raquel said, that you're not routing to, that you might want to route to kind of gauge how one place might be faring against another place. But it's probably the bottom of what firms should kind of be looking at. And I would think if you start repealing some of these things, that firms would take it to the next level on a competitive basis. And I heard Chuck Mack earlier say, well, at NASDAQ, we're using liquidity heat maps. It's like, okay, that's on a real-time basis. That's pretty cool. That's kind of what should be happening for retail and institutional orders. And I'm sure some institutions are doing that today versus their various routing algorithms. So I think 605 is important. It's an important utility to have out there. It's finally at a point where, as we heard that it can be displayed to retail investors to make some sense. But it doesn't really tell you about your execution or how you've done in the marketplace. It's just kind of a guide.
Yeah, I would very much agree with Calvin. I think in an institutional setting, the utility of the reports is somewhat limited, and we should, of course, update them, for any new pricing benchmarks. But just given the complexity of execution in the current marketplace, I think it's just one input into determining best X.
So obviously, the NBBO is relevant for 605. The 605 is a component of kind of looking at execution quality and how broker dealers handling and executing customer orders. In a couple of minutes, again, Jamie, Calvin, anyone, but Jamie, Calvin, maybe we could start with you. Do you have a view on what no access fees, no access fee caps, no Rule 611? Do you have a view of what the NBBO should look like?
Yeah, it's tricky. I do think that there'll be economic incentive if there's no access fee caps to have large fee rebate setups. Maybe if we put aside access fee caps for a moment, I mean, I've heard some ideas floated about what should be, I don't love market share minimums for protection, but maybe it's a reasonable thing to have market share minimums for SIP inclusion. I heard that floated earlier. It seemed like a reasonable idea to me. I think the key thing for me is I've also heard some idea that, oh, maybe we'll have like, competing ideas of what the NBBO is. I think it's a thing that for the end users, but whether that's buy-side institutional or retail investors or whoever, having a single industry standard for what the NBBO is, with which to compare executions to is just highly valuable for a lot of them. And so, I hope that we come out with something that kind of looks like that as opposed to a mishmash of different metrics that one might use. Yeah.
I think as we kind of heard in some of the earlier panels and in some of our letters from 20 years ago, I think whatever goes into the NBBO just has to be accessible, right? It has to be something that all investors can access and that is fair. Beyond that, I think, again, what are we solving for? We're solving for fostering innovation in a very strong U.S. equity market while discouraging kind of harmful fragmentation.
If I could jump, were you going to jump in?
Okay.
If I could jump in just for a moment on that, the vendor display rule in the NBBO is the cornerstone of trust and integrity and fairness in the marketplace. And if you start eroding that, then you really start eroding the marketplace in general. So I think there should be a lot of thought about that. The SIP is not the greatest in the world at all. It doesn't include odd lots. It took all of 4 months to put odd lot trades to the tape. And now here we are nearly a decade later, and we still don't have odd lot quotations to the tape. And look at how much that has kind of fictionalized Rule 605 reports, right? So that NBBO needs to be thought of as the cornerstone of anything you do.
And yeah, I guess one more thing is the NBBO is kind of like, well, what post 611, what is the NBBO? What's it used for? I mean, I guess you have some guidance on what should be displayed on the SIP is one thing, but I think also like the sort of soft signaling of what is in a 605 report probably will filter its way through the industry as well. I mean, you see a lot of examples of places where brokers that are doing best execution analysis kind of use the definitions of 605, even though they're not obligated to, in some sense, to display best executions. As 605 changed to notional, you see a lot of retail brokers starting to change their categorization of the orders that they receive, et cetera. And so, I think there are ways, I guess, to encourage an industry definition of NBBO that are helpful that isn't necessarily obvious in a post 611 world.
I think something else to consider too is, particularly in the context of best execution, is how we define and what we define as the national best bid and what makes that up, and the national best offer in the context of, say, looking 6 months ahead in May of 2026, when we're going to have BOLO, the best odd lot order. From a retail perspective, you know better than I would, Chris, but certainly I would think if that's going to be displayed, what is a retail investor going to look like if the execution quality, yes, even if BOLO is included or odd lots are included in 605, how is a broker going to answer what execution is with, well, this is really the NBBO, because this is how we define it, but odd lots, well, they're kind of in there, but they're not really, without a uniform definition. I don't know what should be done, which is partly the reason why we encourage rescinding 611, because we're already kind of fragmenting the NBBO as it is, with orders that are protected and then not protected, and then you have changing round lot sizes and odd lot sizes. Yes, also 6 months down the road, but that does have an impact on execution quality. So, as an institution, if you have a trader on an institutional trading desk that is crossing a block of stock, even if it's within the NBBO, that midpoint can look very different if you're looking at the NBO versus the midpoint of those two odd lot orders that are the best odd lot orders being displayed in the market. And how does that get resolved?
Very helpful. Thank you. We have about 10 minutes left and a couple of topics that I really want to cover. Maybe this one we can do as briefly as possibly, but another idea for Rule 611 is to maybe modify rather than rescind to include blocks in there. Institutional order handlers, any quick thoughts about whether or not we need more guidance if we were to make that kind of revision with respect to block thresholds? David and Jamie, maybe we can start with you all.
I would suggest we don't need additional guidance on regarding a potential block exception. I think blocks, when you see them these days, and they're not as frequent as they were, 5-10 years ago, they are a very important part of price discovery. Very quickly if you've negotiated the right price or the wrong price on a block. That becomes clear. And most blocks are negotiated in some way, shape, or form. Additional guidance, whether it's principles-based or prescriptive, if anything, I think would further reduce the incidence of block trades in the market, and we don't need that, to happen any less than we're seeing now.
Yeah, I would very much agree. I would hope that David and Met, both view the market for institutional block facilitation as being very robust and healthy and competitive. And I think that, any additional guidance there could be potentially hurtful.
Anna, do you have any thoughts on this?
I would echo that. I think brokers are very good at figuring out how to execute blocks and, where their place in the market. I think we'll be able to figure it out and see what the appropriate measure is.
I would just add that you guys have CAT data, and you could utilize the CAT data to determine thresholds if you're looking at doing a block exemption.
Thank you. At the last roundtable, there were some commenters who suggested that maybe if Rule 611 were to be rescinded or modified, that it may merit some additional customer disclosures directly to customers. One suggestion was that, Chris, I think you've spoken to this earlier on this panel, maybe a disclosure regarding trade through, however that's defined, should be included on a customer confirm. I think another commenter thought that maybe at a point of sale or at the moment of a transaction, a disclosure to a customer of a quote effective bid or offer would be helpful to a customer. In the last few minutes here, maybe Chris, Jamie, Anna, we could focus on y'all and to begin with. What do you think about the utility of customer disclosures? What types of customer disclosures might be helpful? Should 611 be repealed? And Chris, maybe we can start with you.
Yeah, so I think the easiest way is, like I said earlier, you put price improvement on a confirm, put trade through on a confirm. That's very simple to do. I think that's a great solution to kind of start putting those rules back onto the broker dealer where kind of best X belongs. But disclosure is great. I'm going to tell a real quick story here because I know we're short on time. So there was an organization, I think it was a Financial Information Forum, that came out with this voluntary disclosure program around best X that was supposed to make it uniform. Kind of a cool program. So I took great interest in it back in, I think, 2014 when a couple of brokers started doing this. And what was really interesting is in the first month that they did it, and they actually included odd lot orders on that, there was no price improvement. So I wrote something about it. A couple of other people took notice. The very next report, there was a lot of price improvement associated with it. So disclosures can be an effective kind of prodding tool to push the competitiveness of the industry. And I think that things like that would be important. I think, of course, the easiest thing is the trade through piece. So I'll stop there.
Thank you. Jamie, Anna, a couple minutes.
Sure. I mean, I think certainly from a parent order or grandparent order perspective, trade throughs, I think, are probably a little less relevant. I think, in the context of disclosures and how clients evaluate best X, I don't think a disclosure will ever be a replacement for customized TCA reporting or customized engagement that I think a lot of the buy side expects at this point. So I think we just need to balance the cost of having standardized disclosure versus the market solving for kind of bespoke reporting that I think already takes place.
I agree with that. I think currently, when engaging with our clients, there is a lot of information that we disclose and offer and share with them for every aspect of their execution from beginning to end, like TCA reports. And I also think that a lot of brokers today, do disclose, have some sort of standard order routing and trading policy practices on their website. And if that needs to be changed, then, perhaps, with the help of FINRA or other guidance, okay, maybe we want to start including this, but anything more detailed publicly could start to get into intellectual property and, letting information out there about, client routing practices, et cetera.
Can I add just one more point? I want to circle back to those advisors that custody through broker dealers. They would need something. They can't afford to go out and pay one of the TCA providers who's here in the room today what it costs to do that. It's not very cheap. So they would need, I would think, something like a report card that showed them what kind of execution they're getting in terms of a specific disclosure.
Thank you. Well, we have a couple of last questions here. Policies and procedures, obviously order handling, routing, can be bespoke for institutional clients, and retail clients is handled in a quite different way. Any quick thoughts, especially from our broker dealers, about policies and procedures that you have with respect to BestX, and whether or not any kind of public disclosure about those policies and procedures would be useful and or harmful?
Sure, I can try. I think, it could potentially be useful to kind of harmonize the industry expectations around best execution. Obviously, it's a little scary to disclose publicly your internal policies and procedures. So I hope it would come for very good use, or else, yeah. But I think it's an idea.
I think just going back to kind of the Gensler market structure reforms that almost came to pass. One of our primary concerns was that by locking broker dealers into too prescriptive policies and procedures, you're kind of removing their ability to deploy their expertise to solve for best X. And so anything that should be contemplated there, really, we should feel like it is advancing, execution quality and not otherwise restricting choice.
And finally, obviously, the U.S. market has its own market structure, but Jamie, do you have any thoughts about BestX in international markets and how that, are there any lessons learned about how other jurisdictions approach BestX that we could consider?
Yeah, I think you said it well. The U.S. market is very strong. I think we've been heartened by seeing the EC kind of adopt more of a principles-based approach to BestX of late. And, I would hope that would be kind of the model that proliferates.
I would say probably the one thing that was also raised by the prior panels was what we do with locked markets. Not locked markets, cross markets, excuse me. European markets, they don't have an order protection rule. They will allow locked markets to occur and execution of those orders, but they do require procedures be in place to prevent the unusual cross markets and how we handle that. Obviously, the U.S. is different. It's certainly not going to be the same, but in a different context, they too, and it's principle based, but the venues and brokers must have policies in place to how they handle that. So whatever we decide would probably be helpful to figure that out.
Yeah, I guess in the U.S. compared to some other venues that I currently have in mind, I think the obligations are a little stronger currently, more obligations under best execution. And I think the U.S. market for equities is, people keep saying the envy of the world, but I know it's real. And I do think the best execution standards that U.S. broker-dealers have is a contributing factor to, seeing investor confidence and sort of the other people feeling good about the fact that they can be comfortable investing in U.S. assets.
Thank you, David. Thank you, panelists. Please join me in congratulating these folks and thanking them. So thank you, audience, both here and virtually. Be like Chris Nagy. Get us a comment letter by way of the website. We want to hear from you. Thanks to the University of Austin. Thanks for the big Texas welcome and cheer. This concludes the roundtable.